What's up, guys? Mike Sharp here. This is Sharp Investing, and I have a purchase to talk about. I bought a company called QFIN Technologies. They used to be called 360 Digitech, and the ticker symbol is QFIN on the NASDAQ. Now, this is a pretty obscure company. It's another Chinese tech company, and now my portfolio is full of Chinese tech. I've got PDD, BABA, and now QFIN. And I was actually thinking of buying more BABA around 70 bucks, 71 when it was down there. And instead I bought this one to diversify a little bit away from, diversify a little bit in China. That was sort of the original plan. I had a lot of BABA a few years ago, or like early in 2023. And I diversified half of that to PDD, as you can see in my video for that, I think back in May. And now I've added some QFIN. Now I'm over my usual limit of 20% in China, and part of that's due to PDD running up. I think it's more than doubled since I bought it. But this QFIN is just too cheap to ignore. I have been watching it for a couple of years. It is another stock stock idea from my friend Dan, who is the best obscure company finder I know, and one day I'm going to try and force him to come on and have a conversation with me on this channel, because he knows lots more interesting ones in crazy places that nobody else is looking. But for now, let's just talk about why I bought this. This is mostly a trade for me. This is not a permanent position. There's a few reasons why I don't think I want to hold it for a long period, but I bought it partially because of technicals. It's at the sort of bottom end of its normal range. And I'm kind of looking for a quick bounce, but you'll also see when I get into the financials how cheap this thing is. So cheapness and technicals both look really good to me. And there's a few other reasons why I like the company. They survived in COVID. They did quite well in COVID, even though that situation was quite poor for them. So it made me feel a lot safer in buying this company. So I bought about 6% of this company, or 6% of my portfolio, not the company, at $14.11, I think. And I was going to put it to 10% if it fell further to 12 bucks. It hasn't done that yet. It's trading about 15.5 today on the 28th of December. So what are they? They are a high interest lender that serves underserved borrowers in the Chinese market, people that sort of fall between the big financial institutions and some other available options there. Now, credit cards aren't as prevalent in China, so it opens up a bit of a door for these types of lenders. You can kind of think about as maybe a buy now, pay later type company, or a credit card alternative. They charge high interest rates, and the average sort of loan, they give people lines of credit, but the average tenure on the loan is about 12 months. So think of it, buying something for $1,000 and then paying it off over 12 months. So that's sort of the idea here. They have done quite well historically. The numbers look really good in terms of the profitability, and I will talk about them now. So PE, this is the obvious one. Price to earnings ratio is below 4. When I bought it at $14. Right now, if you annualize the last quarter earnings were 96 cents per ADS. If you annualize that, it's almost $4, and that's about 4 times earnings at $15.50 stock price. So you can see that it's unbelievably cheap at these levels. Now, I don't know if there's any reason to believe it will get a multiple in the future, so that's one of the risks I'll talk about in a bit. But just from a pure numeric investing standpoint, some of these numbers look really good. So you have operating margin at 33.5%, and operating margin is the kind of the one you want to look at because it's before like the Forex charges and stuff like that. So operating margin is quite healthy. Net income is still really high at 27.6%. Return on equity is around 20%, right? So their equity is about 2.9 billion. And I'm thinking they're going to land at about 575 million in net income this year. So that's a 20% return on equity. That's a great ROE for a bank or a lender. And they just continue to post profits every quarter. In terms of growth, there's some really nice numbers here. They have, actually the revenue hasn't gone up a whole lot I think it's 3%, 3.3% in quarter three versus the year before. And over 9 months, it's actually down. But one of the things that they've done here is they have part of their lending is off their balance sheet, right? So that's what they call the capital heavy lending. And that they take their balance sheet and lend it. And there's quite a lot of risk with that, because if their loans go bad, then they eat all the losses. But over time, they've been moving to this sort of capital light model where they connect the borrowers on their platform and financial institutions. So they have over 200 million people on the platform. They have 155 financial institutions that they connect them to, and they use their technology to sort of assess the credit worthiness of the borrowers and figure out what the appropriate credit limits are and stuff like that. And so this is the key part of the business, and they've been pretty good at containing their loan losses by selecting the right borrowers at the right loan sizes, right? So if you look at their actual active borrowers, they have close to 50, I'm trying to find it here. I think it's close to 50 million in approved line of credits. That's of more than 200 million people who've signed up to their platform. So they're approving less than 25% of people for actual lines of credit. So they're being pretty, they're being pretty picky about who they actually lend money to. And then of those 50 million, I think it's 20 something million actually have active balances outstanding. So this is what they've been good at in the past, is sort of managing risk, which is the key thing with this type of business. If we go back to the growth rate, so the revenue hasn't grown that much, and that's because what they're doing is they're going from this capital heavy model and moving their volumes over to this capital light model, which reduces the risk that they have to absorb, right? And so the capital heavy revenues come down quite a bit, and all the other types of revenue have gone up. So they basically have been trading, but at the same time, the EPS is growing, even though the revenue looks pretty stagnant right now. So EPS is up 12.3% in quarter three. So there's some good growth there. Their borrower base is growing at also 12% year over year. The loan balance is actually up 18.2%. So the loan balance is growing pretty fast. If we look at what else do we want to talk about here from financial statements? So balance sheet, at first glance, it looks really strong. Like you can see 1.1 billion in sort of cash, which looks really good. And then you go through it and say, oh, there's actually no debt. But then if you look closer, there's this sort of 1.7 billion that's payable to investors. Now, I didn't dig enough to figure out what that is, but I'm gonna treat that as debt. That sounds like a loan from investors. So I'm going to treat that as debt. Maybe it's not, but I'm going to be safe and treat it as such. So the net debt is actually 600 million if you do it that way. So enterprise value is slightly higher. It's about 3 billion. But still, if you take the any kind of earnings number divided by the enterprise value, it's still very good. It's still like, if you take EV to earnings, it's still 5x. So it's still cheap, even if you use the debt, that net debt figure. The key thing here, like I was talking about, is the delinquency rates. So delinquency rates have stayed very low, which is the thing I've been watching over the last 2 years. I went back even further than this to see how they've done over the longer period, but typically they haven't really seen any spikes in delinquency ever. And I think COVID was a good test of that, because that destabilized the economy pretty severely and people's spending went down. But it looks like over COVID, their actual delinquency rate actually came down. So maybe that's because people were saving money and they weren't spending as much and were able to service their debt more. I guess we will see, though. Now, it's a little bit of a tick up here to 4.6% on the D1 rate, but long term, that's still quite low. And the recent rates are trending as normal. So but that's the one I'm going to keep an eye on quarter to quarter. If that starts to spike up, I am out. If they start to spike before I get the return I'm looking for on this short-term trade, then I'm gonna ditch it. So one of the the things I've learned, I've actually invested in a company like this previous to COVID called QFIN, and they made one really bad decision on who they were lending to. They expanded their lending criteria to allow sort of like lower, just the next tier down to who they were lending to, and basically blew the company up. So that's the one I want to keep an eye on, the D1 rate. And there's some other metrics that they put out as well, in the delinquency rates, that I'll keep an close eye on. So I think that's sort of the general idea of the company. It's just cheap. It's just crazy cheap. It's got growth, and the margins are great, which shows that they have a product that people want that's not being replaced currently, and they're not getting squeezed on their margins. So, it looks pretty tasty on all those fronts. Now, I want to talk about the risks too. So the main risk here is, again, Nassim Taleb, same book, Black Swan. Oh, I talked about it in another video, but he talks about the 1001 days in the life of a turkey. So the turkey, if you haven't heard this, so the turkey on the farm, for 1,000 days, he's got this nice farmer. The farmer brings him food and water, and everything's great, right? He's got a place to sleep, eats food, no problem. The wildlife's kept out. He doesn't have to worry about any sort of wildlife coming to get him. Life's great, right? So you got 1,000 days of a turkey where everything's great, and then on the 1,001st day, the axe falls on his neck and he's gone, right? So the idea is that just because it's been fine in the past doesn't mean it's going to be fine in the future, right? So if we look at Bear Stearns, this is sort of the idea with them. They had, I think, decades of success, and then one day, the result of a bad lending decision, a series of bad lending decisions led to their demise. So that's the main risk with a company like this. One stupid decision that could blow them up, right? And that's why we have to keep an eye on that stuff. So there is a risk of a zero here. I think it might be small based on their history, but it's there. We have to be aware that that's there. What else? I think the other main risk that I'm looking at right now is Alipay and WeChat. I think that, to me, this looks like a Fitbit risk, right? So Fitbit was a product everybody liked, and people wanted it. They loved it. They bought it. And then as soon as Apple decided that they were just going to make a watch that did all the same stuff, the size of them was able to really put a hole in Fitbit's plan, because Fitbit had one small product that people liked, whereas Apple could tie it into this huge ecosystem and basically squash them. Same thing for Samsung, but I think Apple's the main example here. So I think Alipay and WeChat, Tencent has the same opportunity here if they want to take it, right? If they aim at the same segment of the market that QFIN is aiming at, it could be, they could take a lot of their market share. Now, I think one of the things that QFIN would say is that their technology and sort of their credit scoring is their moat, or is their sort of competitive advantage. But I think that if you're looking at Baba or Tencent, the data they have, it wouldn't take them that long to sort of get up to the same level as QFIN. So there are some risks there. Those are maybe more. One of them is like an instantaneous risk, and one is a sort of a longer term risk. So that's it. That's QFIN. Quite interesting little company, and I will keep an eye on it, and I will let you know if I sell it. But final word is, this is not investing advice. I'm just a guy who's posting his trades online just for my own use. I can analyze my own investing because there's some accountability going along with it. So anyway, thank you so much for watching, and I will catch you in the next video.